Hello and welcome to episode 286 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, welcome back. How are you doing?
I'm very good this week. I'm buzzing this week. We've had new additions, haven't we, to the Money to the Masses family. So the team's grown bigger, but if you follow our social media channels, which I have no doubt that you will do, you will have seen that we have expanded. Now, I'll touch on the first one, which was Lola the dog. Andy's got what breed is she, Andy?
She's a miniature schnauzer.
Yeah, miniature schnauzer, which basically means cute. This tiny little dog, and she's really well behaved. Andy brought her into the office this week, and we're hoping it's going to become a regular occurrence. She was so well behaved, wasn't she? She didn't bark, didn't do anything. So she was incredibly well behaved. So
heavily sedated.
It felt like that because she slept so much. But yeah, she followed us all around the office playing. So that was brilliant for morale to have an office pet. I've worked in an office before with an office pet, and apparently they are good for team morale, for having one focal point where everybody looks after and cares for and looks out for. Apparently is very good for team morale. But the other more important addition to the team was Harvey. Now, Harvey has joined the Money to the Masses team. We went out and got Harvey, convinced her to come to Money to the Masses, and it didn't take much convincing because obviously it's a fantastic place to work. And Harvey is now heading up our protection writing. So she's going to be doing a lot of the writing relating to life insurance, income protection, the side of the business, which we have a lot of expertise on, but Harvey brings a lot to the table. So it's fantastic that she's joined. You can contact her if you want to, harvey@moneytothemasses.com. She's got a wealth of experience. It's really good to be expanding the Money to the Masses team, particularly in this environment as well, which is obviously very positive. We're going to have some further additions to the team to announce in the coming weeks and months, so keep an eye out. And we've obviously had to expand our offices too, so it's all a very good news filled to this week. And for Money to the Masses history, it's one of those, another iconic moment. So yeah, it's been fantastic. So I'm absolutely buzzing, Andy, and I know you were as well after Harvey's first week on the job.
Yeah, it's genuinely been really refreshing to have a new face, new ideas, and lots of passion to really put more and more out there, and we can help more and more people. It's been genuinely a breath of fresh air. And like you say, we've got more people coming to Money to the Masses. And so that is going to help us drive more and more content. And we're talking videos, articles, all sorts. So it's exciting stuff. In fact, we've even created a new studio as well, where we're going to be able to pump out excellent quality videos. So it's all good. So moving on to the podcast side of things, what have we got coming up on this week's show?
Okay, so this week I want to talk on the investment front about stock splits, what they are, what the impact is on the stock in question, and how investors might get exposure to a stock split, whether it's a good idea, in fact, in particular via funds. And I'll go into more detail on the piece, but a stock split is where you get a company announce that they're going to actually increase the number of stocks or shares available for their company. And there's reasons why they do it. It causes a lot of excitement. And the reason in particular which it's relevant is because Apple and Tesla did it this week. And so lots of people, you've seen things probably in the press, and people say it's fantastic. It means the stock price is only going to go higher. You need to jump on board. And I'm going to look at the truth in that statement. And then moving on, there was actually, before we did this podcast today, I was looking at things that I would probably talk about on the podcast. And then sometimes you get a story that comes along and just knocks a lot of the others out of the water. And this one is around pensions. And I've mentioned it on my Twitter feed today. So it's Friday today, and it's caused a lot of stir and a bit of upset. But it's to do with the government now announcing or confirming that the age at which you can take your private pension is going to increase from 55 to 57 in the coming years. I'll go into more detail on the piece, but it is such an important topic because there'll be a lot of people who won't notice this and it will pass them by. And I'll explain why I think it's such an important topic. And finally, it links quite nicely to Harvey starting and employing new people. You're going to do a piece, aren't you, Andy, on a new government scheme that's been announced to help employers recruit younger people?
Absolutely right. It's called the Kickstart scheme, and it was announced a little while ago, and people have been waiting with bated breath for more information, what it means for employers, what it means for young people, and those details were announced this week. So we're going to cover off the main points on that, who it's good for and who may be able to benefit from it. So we'll cover that at the end of the podcast. What are we going to start with this week?
Let's start with the pension age change. Now, this is important. So what's been announced, the government has just confirmed that the minimum age at which you can access your private pension, which is currently 55, is going to increase to 57 in 2028. So that means in a not too distant future, you are only going to be able to access your pension or technically retire from 57. This is completely separate to the state pension age. Remember, the state pension age is older. It currently is about to be 66 for everybody from October this year. But the reason it's important, there'll be a lot of people who don't realise that the change is going to come. So they may be reaching an age of 55 around that year, 2028, thinking they're going to be able to retire, draw down on their pension, access their pension benefits under the pension freedoms which people have been enjoying, and then suddenly they're going to realise that they can't. So first of all, why is it happening? Now, while lots of people are suddenly in shock at the announcement, and there'll be lots of people who are listening to this podcast suddenly thinking, hold on, that means I'm not going to be able to retire at 55 or access my pension at 55, even if they want to continue working as they had originally planned. And of course, that's going to suddenly cause a lot of confusion and perhaps worry for people. But the reason it's happened is back in 2014, the government announced an intention to increase the age at which you could access your pension, the minimum age, from 55 to 57. But of course, other things got in the way, including Brexit. These things seem to go on the back burner. And there were people thinking that perhaps the increase wouldn't happen. But this week, they confirmed it's going to. So that's made it very real. So it's actually going to happen now. It was always on the cards. So one reason the government is obviously doing this is because of longevity. So we're technically living longer now because of improvements in medicine, etc. So people's pension pots need to last a bit longer. So what they're doing is by increasing that age, it's limiting the time that you've got to make your pension last. And it's also to encourage people to stay in work because hopefully, in theory, people are going to be healthy and be able to work a little bit longer anyway. So this is all fitting into the government's aim of trying to get people to work for longer. You could argue that they obviously want people to pay more tax, etc., to keep working because they're going to have to fund the ageing population that's out there. But back in 2014, the government first announced that the state pension age was to increase between 2026 and 2028 to 67. So the state pension is increasing. It has been for some time. So the state pension has been having radical changes to it, the state pension age, since about April 2010. And over that period of time, we've seen it gradually increase, and it's going to head towards 68, in fact, in the coming future. So at the moment, people who are retiring this year, the state pension age from October, so basically about now, it has risen to 66 for men and women. And then it's going to increase from 67 to 68 between 2044 and 2046. Interestingly, when I looked at it, I'm going to be one of the first people who retires at 68. Or my state pension age is going to be 68. But the reason that I mention this is because I want people to bear in mind that notionally, there is about a 10-year link between the state pension age, your official state pension age, and the minimum age at which you can access a private pension. So if you think it used to be 55 for a private pension was the age you could retire, and it was 65 for your state pension age. Of course, the state pension age has been increasing. So the minimum age which you could access a private pension was always likely to increase as well, to keep within that 10-year buffer. It's just always been that kind of elastic band that's been stretched a little bit, but now is going to be pulled back as we've had confirmed this week. The point is that if you're upset about the idea that your personal pension could not be accessed now until 57, then in reality it's going to be certainly closer to 58 by the time I retire, and a lot of people who are listening to this podcast, which means if you're below age 40, for example, you are certainly going to probably not be able to get your personal pension to your age 58. Now, that's not definite, but I'm just basing it upon history. Now, the one thing I want everybody to do, they heard me say different numbers and different ages for when you can access a state pension. The big message from this part of the podcast is there's a whole timetable of the changes in state pension age, because they don't just go, right, one day it's 66, next day it's 67. They phase it in over a period of time. So you'll get people who have a retirement age that could be 65 and 6 months. And then somebody else who's born a bit later, it could be a little bit older, 65 and 7 months. So it's phased, and there's a whole timetable. I'll put a link to it in the show notes, which you can have a look at. But more importantly, everybody, no matter if you're 15 or 55 listening to this, go to gov.uk/state pension age, and you'll get a tool. All you have to do is put in your date of birth, click go, and it will tell you your state pension age personally based on your date of birth. So mine is, as I said, it's going to be 68. And everybody needs to know their state pension age. And the reason it's important is because when they first started to increase the state pension age for women to sort of bring them more in line with men, there was a group of women that were born in the 1950s who didn't realise that was happening. So the government didn't communicate the change very well. So they were still thinking that they were going to get their pension, their state pension that is, at the age of 60, then realised it was actually increasing, and it could be as long as 5 years they'd have to wait to get their state pension. And so a lot of them said they've been in financial hardship, etc., because they've been planning to retire with a state pension at age 60. This change in the minimum pension age for your private pension is a good reminder for everybody to, first of all, know your state pension age, and then take 10 years off of that and assume that's probably going to be the age at which you can take your private pension, regardless of what the rules are now. If you do that one thing today, then you could stop a lot of heartache and struggle in the future because you've not made plans for it. Now, the government have said they're going to communicate the change on the private pension age going forward. Based on past history, they'll probably do a very bad job, and there'll be lots of people who won't realise that they're not going to be able to get their private pensions when they want to. So that's why it's important that we cover it today, to get people to realise that. Now, obviously, 2028, I don't know how they're going to phase it from age 55 for the minimum age for a private pension to be accessed to 57. They haven't laid out that timetable in exactly, but you just need to know that obviously people are going to be 55 in 2028, 2029, could have to wait a bit longer. But one of the other things I want people to take away from this is it emphasizes the importance of flexibility when you're doing anything in life. So if you're saving for retirement and you've got this plan that you want to retire, there are going to be a lot of people who are going to be upset the fact that they can't now access their pension until they're 57. And I know that a pension, if you look at it, is probably the most tax efficient way still to save for retirement. But there is still an argument for having investments and savings that are not in a pension wrapper to allow for an element of flexibility for a scenario like this one. So you could access money, say you have money in an ISA as well as saving into a pension. It doesn't have to be one or the other. I'm a big fan of flexibility. An ISA doesn't have the rules about accessing based upon age. If you had a pension portfolio and an ISA portfolio, these rules just mean that you might have to access your investments for a couple of years before you get to age 57. You think of it as one giant pot, but they're in different structures that allow you a bit of flexibility. Now, of course, you could argue what's to stop the government changing the rules on, say, ISAs, but history shows that they don't tend to do that. I mean, we've seen the pension rules change massively, and the one thing you can guarantee, they're going to keep changing year on year on year on year until we almost get to our own retirement. There's constant change. It's incredible since I've been in the industry. Stocks and shares ISAs have been around now for 20 years, and there's been fundamentally no change to them other than you can put more money in and you have more flexibility than what you can invest in. Of course, you don't get the tax relief on the way in, but you do get the lack of taxation on the way out with ISAs. So there are different types of products, different wrappers, but they should be all part of your toolkit when you're trying to save for retirement. And so I just want to be positive, because I know there'll be people who'll be disappointed. If you've got plenty of time until you get to age 57, then you may want to start to think about the flexibility of how you're saving for retirement, to allow for the fact that things might not work out quite how you want them to now, because you might have to have a couple of years you need to fund before you access your pension. And the other thing to bear in mind is you're not going to access your pension all on day one. I mean, that doesn't make a lot of sense. There'll be some people who might want to, but it doesn't make sense from a lot of reasons. A, making your money last, but also taxation. So the first day you want to retire, you've got your pension pot. Most of it you won't access until like for decades, even once you officially, in inverted commas, decide to retire anyway. So all you need to do is be able to last a couple of extra years. You need that cash buffer. But also think back to March this year when the stock market absolutely tanked. And there were people who saw their pension funds who were coming up to retirement potentially fall 40% in a matter of weeks. Now, if they'd have accessed their pensions at that point and crystallised a whole load of it, they've effectively crystallised that loss of 40%. If they'd had some money as a buffer that enabled them to, if they didn't want to continue working, because don't forget, continuing to work is always an option, they could have accessed and drawn down on that other cash reserve they had elsewhere outside of their pension to be able to provide some income, some money, until they decided they want to access their pension. Now, there would have been some people who may have done that, and they've seen their pension value rebound, and then they might decide to actually now access their pension in today rather than at the bottom of the market in March. There's a lot of luck in that, but it just goes to emphasize that it's not a bad idea to have a bit of flexibility around your retirement date and realize that markets might crash. Things might not go quite as you'd expect them to do. Legislation may change. So don't always plan. You can only play what's in front of you, but you've got to always plan to allow a bit of flexibility in your future. So hopefully it's a bit of bad news for some people, but I just want to give people a bit of realism that this is the direction of travel, and they just didn't realise perhaps that it was, and it's only going to keep going that way. So we need to work with what's out there, and hopefully it won't be a disaster.
Yeah, interesting stuff. I saw that news this week, and I thought it might be a good piece for the podcast just to clarify things, and it's something that I'd pondered. I know, for example, my state pension age would likely be 68. In fact, you haven't given those tips, Damien. I went and checked it while we were talking about this on the podcast, and indeed mine is 68. And I suppose I was thinking in myself, if I can access my private pension at 55, the temptation there, and then having to make it last 13 years at least, and it's taking that temptation away for me. For me, I don't see it as a bad thing, but I've got a long time to go. I imagine those that are closer to retirement and who didn't know it was coming in, it's a bit more of a headache and a bit more of a situation they have to get their head round.
Yeah, you're right, Andy. Those people, it is a problem, but they've got time to have to try and mitigate it. The problem, this is why I want to do it on the podcast, the problem has been in the past where the women who were born in the 1950s didn't realise, and you have to understand, in this world, you are responsible for yourself, whether you like it or not. The government isn't going to necessarily hold your hand, make life easy for you, despite the fact they should really have an obligation to notify people, but they won't. So the responsibility is yours. So everybody listening to the podcast now knows when they're going to retire, has a better idea that actually when they're going to be able to access their pension, and hopefully has been now shown the light that, flexibility needs to be built in as well. There's more than one way to fund a retirement.
Okay, moving on to the next piece, we're going to be looking at stock splits. Damien, what have we got?
So stock splits have hit the headlines because, two very popular companies, Tesla and Apple, have announced a stock split in August, and it actually happened this week. So people get excited about a stock split. They think it means the stock price is going to get a boost, it's going to push higher, and therefore people might want to invest in it. So I want to explain what it is, how it works, what it really means. So a company has a number of shares that are in existence. So we say Apple. I don't actually know how many shares of Apple are in existence, but it's a hell of a lot. And then each share has a price. Now, if you total the value of those shares by multiplying the price by the total number of shares, you work out what the market cap is for the entire company. And of course, Apple, it exceeded 2 trillion recently, and actually is bigger than the entire FTSE 100, which is mind-blowing in my view. So what happens is every now and then you might get a company, and it's much rarer than it used to be, announce they're going to do a stock split. So Apple said they're going to do a 4-to-1 stock split, and then Tesla days later said they're going to do a 5-to-1 stock split. What that means is if every person that had an Apple share after a particular date would say state what that date is, and it was this week, instead of having one Apple share, they now have 4. So think about the total value, the total shares in existence of Apple as a whole cake. Then what's happened is if you chop that up into lots of slices, and each slice represents a share, then when they do a stock split, they just do more slices. So the cake is exactly the same. The market cap of the company, in this case Apple, is identical identical. All that happens is that each person who had one slice has now got 4 slices that is just equivalent to their old slice cut in 4s. Equivalent of, if you want to think of it in monetary terms, it's like you having £1 or 5 20p coins if it was a 5-to-1 stock split. So you can see it's the same thing. It's just a bit of sleight of hand, a bit of magic, as it were. What you'll then realise is nothing fundamentally has changed. The same people own the stocks. The ownership hasn't changed. The company hasn't changed. What it does hasn't changed. Its revenue hasn't changed. It's just suddenly just meant there's a lot more shares in existence. And instead of owning one, you might have a case of Apple 4-to-1, suddenly have 4. And so the question is, why would you do it? And historically, if you go back into like the 80s and 90s, stock splits would often happen when a company's share price got to a certain level. And if you think about it, if you wanted to own a share in a company and the share price got to $100, say, then if you wanted to own a share in that company, you had to have $100 to be able to buy just one share. So as a company becomes more and more successful, so its share price should hopefully reflect that success, then you'd get to a point where you couldn't actually afford, as an ordinary person, a sort of Joe on the street DIY investor, be able to own a share in that company. Now, as a company, you may actually want to give people who are ordinary investors access to your shares. You might want them to own it. That might be just because of your view on things, but also you might not want to be owned by a smaller and smaller group of people who can just afford to pay the value of your shares. So what they would do is do a stock split. Suddenly, let's just say a price of a share was $1,000 for a share. You do get that. Of course, there are some that are tens and 20,000s for one share, and that prices out ordinary people. You can't therefore buy one of those shares because you haven't got enough money. But if they did a stock split, so you had $1,000 per share, and you did a stock split that suddenly, let's just use round numbers to make it easier for me, that suddenly 10-to-1, then what would happen is each of those shares are now worth $100. The company market cap has not changed. The ownership and who owns them hasn't fundamentally changed in any way. But it suddenly means that people who have a couple of $100 can start trading and buying shares in that company. So that can be obviously a positive. Now, back in those days, so we're talking 80s and 90s, people were much more inclined. There was a bit of a bull market that people were inclined to buy individual shares of companies and wanted to gain exposure to them. If you think about the world of funds, it wasn't quite where we are today. So they were buying individual stocks and have a stockbroker, say, particularly in America. And so they were buying these things. It suddenly opened up the market to ordinary investors. And therefore there was a bit of a frenzy of people buying them. But of course, when we had some cataclysmic events in markets, I mean, you could go back all the way through the 80s. There were some in the end of the 90s, the dot-com bubble burst. And some people were burnt by that. So suddenly owning stocks wasn't as popular. But what it did is it gave people access to buying stocks who otherwise couldn't afford to. And it helped fuel the market. But of course, then people nowadays are probably less inclined or were for a period of time until we got the sort of Robin Hood traders that we have now of buying individual shares. So there was less euphoria about it. So people were able to buy shares in these companies. And it was almost seen as a positive. If you were a company, your share price had got to say like $100, you're obviously doing something right. We're going to do a stock split. And then suddenly people are thinking, well, the share price is going to keep going higher again because this company's doing something right. They've done a stock split. It's almost like a big hello to all investors out there. Look how great we are. People then pile into it and it would be seen as perhaps a virtuous circle where therefore the price could go higher again because you've got a new wave of keen investors. And so when Apple and Tesla announced it, it was greeted with this whole, wow, there's going to be a further rally in the share price of these companies. This is great news. But when you want to look at it, what is the reality of a stock split? Does it really turn into better performance? Now, before I go on to that, I just want to highlight that back in the, say, 90s, you would see maybe 100 companies in a year doing stock splits on the S&P 500, which is the US stock market. If you go back in recent years, you're probably seeing maybe 5 companies a year doing something like that. And we've had 2 big names this year in Apple and Tesla doing it. And why is that? Now, one of the reasons is because it just doesn't add any value. It doesn't do anything for current investors, if that makes sense. You're just doing a bit of jiggery pokery. It's a bit of sleight of hand. But also, there is an argument that if you suddenly attract a lot of keen DIY investors, they're much more flighty. So they're just owning the stock because they think it's going to go up and they're just as likely to sell it. Whereas if you have people who can actually afford to pay £10,000 or dollars for your share price in your company, or even hundreds of dollars, then it means that they're probably going to be much more buy and hold investors or professional investors. So it's going to be, from their point of view, perhaps the type of person they may want. Of course, stock splits are good for DIY investors. It allows them to get on board, but professional institutions don't necessarily like them as much, because if you split the stocks up, so suddenly they own many more stocks than they did in that particular company. When they trade them, the commissions they had to pay would be higher because you paid the commissions on each share that was traded. So they weren't so keen. Now, that in part explains why they probably were fewer and fewer stock splits as the years have gone on. But another reason is actually because you can now own, there are platforms out there that can allow you to own fractions of a share. So you can have fractional shares now. So some people who couldn't previously own shares in Apple, can now gain some exposure to them. So that has changed the dynamic somewhat. But if you look at the analysis of what actually happens after Tesla announced that they were going to do a stock split, well, put it this way, their share price went up about 40% in 8 days in August, and their share price since the lows of March is up about 500%. Now, obviously, most of that was before the stock split was announced, but when the stock split actually happened this week, their share price jumped 12% in a day. Apple's jumped 4% in a day when theirs happened. And of course, people are saying this is great, it's only going to go higher. The next day, all those gains reversed. And if you've been watching the markets, it was almost spooky when I did the midweek markets this week. I said volatility might pick up. No sooner did you publish that, Andy, than the technology stocks fell through the floor. The VIX went through the roof. And we're in a bit of a mini crisis in markets this week. We have to see what's going to happen if the sell-off in America is going to continue. And actually, that gives you a hint that while the stock split doesn't add any real value to the company in terms of change anything about the company, for those who hold the shares, who will buy them, it doesn't really add any value either, because there was some analysis done by a company called Schaefer Investment Research going back to 2010, and they looked at 240 stock splits, so 240 occasions where a company has split its stock, and looked at the performance before and after versus the wider market to see if it did mean the stock price for that company rallied afterwards, as lots of people say it tends to do. That's the conventional wisdom. But when you look at the analysis, the odds of a rally in the share price after a stock split occurs versus the wider market, which in this case was the American S&P 500, over a 2-week period, it was only a 40% chance. It's a bit more than that. It's about 48%. So it's just below 50% chance that particular company's share would outperform the wider market. So that suggests it wasn't necessarily a good thing. If you extend that period and look at 6 months down the line, 6 months after a stock split, the odds that share would outperform the wider market, so where there wasn't stock splits going on, was only 50%. It's toss of a coin. That basically means it didn't really have any impact. So it just confirmed that a stock split doesn't actually make any material difference to the company, but in terms of performance, which is what investors are really interested in, it doesn't really make any material difference either, despite what we've seen with maybe Tesla and Apple in recent weeks and months. And a lot of that euphoria is pretty much down to the Fed pumping money into the market and technology stocks generally being on a massive tear higher. So the message is stock splits, they're interesting, but research shows you shouldn't necessarily get too excited about them. But we probably will see more of them going forward, because they do give a new breed of investor come into the market, and they could help support the market, even if they don't send it much higher. There are some people who still think, despite what the research shows, that they are a good thing for the market. Now, companies that we're likely to see do it in the future are technology companies, Microsoft being one, perhaps Amazon, Netflix, Facebook. So don't be surprised if you see some of those other companies start to announce stock splits, because they want to allow people who buy and enjoy their products to actually buy shares in their company as well. Now, despite what I've just said about the fact that stock splits don't make a lot of difference, you may still be keen to want to try and get on board and try and ride a wave if there is one, because maybe this time is different, as the phrase goes. We are in a slightly distorted market. Now, I would give you a tip of how you could go and do that via funds. Buying the stock itself is quite risky, but it's really to gain exposure to the companies that are surging high at the moment, and that is tech stocks, because they are the most likely candidates for a stock split at the moment. So if you go to the global sector of funds and you rank them over 6 months performance, you will almost certainly find the funds that have the biggest exposure to Tesla, given that their share price is up 500% in the last 6 months, and the likes of Apple and any other big technology stock. So that would be a very easy way to be able to ride that trend. And at the moment, the tech stocks are still flying high despite the pullback we've seen. Whether it's actually as a result of the announcement of that stock split is still debatable. I think a lot of it is just down to the fact that there's lots of easy money flowing into the markets. There we go, Andy, answering the question of stock splits, why do they do it, and is it worth chasing them?
Okay, and that brings us on to the last piece. And we were talking earlier about money to the masses employing new staff, and it got us thinking, and it reminded us that there's a new government scheme that's aimed at helping out both employers and young people get into work, because it's incredibly difficult at the moment, especially with what's going on. So what is this new scheme? It's called the Kickstart scheme, and the information was released by the government this week. And it's a government funded scheme that will be paying 100% of the age relevant national minimum wage and national insurance and pension contributions for up to 25 hours a week for certain individuals. So this scheme is aimed at both companies employing young people and obviously the young people themselves, who can then benefit from the jobs that become available through this scheme. The scheme is targeted at selected out of work young people, which is essentially anyone between the ages of 16 and 24 who are out of work and claiming universal credit. So anybody who falls into that category can apply for a job through the Kickstarter scheme. Now, although the Kickstarter scheme is now open for employers to register their interest, they're saying it's going to take till around November for all of that sort of paperwork and everything to go through, and then for the jobs to start being available. The idea is the scheme will enable young people to get into work. It can help them gain experience, skills, training, and the confidence. Now, the scheme is only designed to cover salaries of those individuals for up to 6 months. And then the idea would be that those people could take those skills that they've learned and either apply for a full-time job through the current employer that they've been benefiting from this scheme, or to take elsewhere in the working world. And, you know, it's a good way to improve the CV of a young person. Interestingly, what's pretty good about the scheme is that any employer that sign up for this will get a £1,500 grant. That's £1,500 for every 16 to 24-year-old that they train through the scheme. And that £1,500 is designed to help cover the training costs, but also things like maybe the additional travel if people need to be collected from anywhere, to cover uniforms, all of that kind of thing. Now, there is a bit of a kicker with with these kind of schemes. There's always a kicker, and no pun intended. So there's a couple of things I've picked out which I don't think are potentially great. Young people need to be claiming universal credits. They need to be going through the job centre. They need to be actively already looking for jobs. So there might be someone that an employer has in mind, that, you know, the daughter or son of someone that they know that isn't yet in the system, if you like, that would be perfect for this. Well, they might not necessarily qualify, but I suppose, you know, that's a way that they can keep an eye on everyone and make sure that the scheme runs effectively. There's also a kicker from the other side. So unfortunately, at the moment, only the larger employers can register their interest directly with the government. So that is people who can offer more than 30 Kickstart roles. So you're looking at big companies like, for instance, Tesco have already said that they've signed up. Network Rail have signed up. In fact, Tesco have said that they're already going to be offering over 1,000 jobs through the scheme, which is obviously a good thing. But think about those smaller employers who maybe only have 1 or 2 roles to give up. Their job to get on this scheme is more complex. They effectively have to do it through an intermediary. So at the moment, there's limited information. It only came out this week. More and more information is being provided by the government. But at the moment, they're saying that smaller employers will have to pair up with other people. So they might need to go to similar employers until they can get a pool of people and get more than 30 together as like a conglomerate. Maybe they can go through their own local authorities, trade bodies, or registered charities in order to sort of pool together and sort of apply as one. So that is going to be a bit of an issue. It's complex, and from the stuff that I've read, there's lots of negativity around that. In fact, people have said that it could take up to 3 or 4 months for those people to pull together, ensure that there's enough training, enough people. Obviously, these people have all got to talk. It's just a bit of a mess. It's a shame that the smaller companies can't just apply directly, but I suppose, they've got to start these things. This scheme is due to run until 2021, and then they're going to look at it again.
I think it's a worthwhile thing to put on the podcast, Andy, because the people listening to this won't necessarily know how the scheme works or that it exists. And so if they are somebody who is young who could benefit, or know somebody who might be able to, they can at least point them in the direction to say, look, this exists out there. And then they may be able to try and find opportunities that exist through the scheme, or even if there's people who they might know who might be able to use the scheme to inadvertently employ them, maybe. But it is disappointing to hear the various caveats. And I know there'll be people who listen to this and go, well, yeah, it's another scheme that we've all got to pay for, etc. But yeah, that is the real world. And they're trying to help young people get into work, as we've already done. The one good, one bad. One bad, they're going to have to work forever and never get a state pension or be able to retire. At least let's have some positive that there's down the other end, that they'll be able to potentially get some help in getting a job. So I think we're done, aren't we?
That's it. We're done for this week. So if you want to get in touch with Damien, you can do so in the usual way. It's Damien at moneytothemasses.com. Of course, Damien's on Twitter. It's at moneytothemasses with the number 2. We've got Instagram. Don't forget to be a part of our Facebook group. It's facebook.com/groups/ Money to the Masses. We've got over 2,200 members in the group right now. Make sure you're a part of it. You can post your questions in there. And sometimes we take those questions and we end up doing a piece on the pod. So do ask your questions. And of course, you can review the podcast as well. Head over to wherever you download your podcast and put your review. And if you screenshot that and send that over to Lauren at moneytothemasses.com, not promising anything, but if you let us know that the review is there and you claim your review, you may well get yourself a coveted Money to the Masses mug and get yourself eventually on the Money to the Masses mug wall of fame. So there we go. Damien.
I'll tell you what, actually, I just remembered I didn't talk about my weekend away. Maybe I'll do that next week. I don't know. Because I travelled north. I like to be inclusive. So I went all the way to Sunderland and York and places like that up the north of the country. And it made me think that I was staying in B&Bs with my family and seeing the in-laws. It would almost be fun if one day you and I did a tour. I'm talking after coronavirus. We did a tour of the UK and actually visited some places where podcast listeners live, and did a bit of a fun trip. Maybe recorded some podcasts to meet people, because obviously it's a national broadcast. And it's just a great reminder when you're travelling up and down the country. There's a whole world outside of London, and I think a lot of people forget that. But anyway, something to think about when we eventually do a meetup. So that is it. Okay, till next time.
Until next time.